Okay, everyone. Hi again. This is Tao Chai. We are going to be looking at depreciation. We're going to be analyzing business transaction part 7. Okay, so at the university library, it's going to be. I just want to apologize if you guys hear students talking in the background. Okay, let's go. Okay, so we are going to start off with a little inspiration from Plato. He says, we can easily forgive a child who is afraid of the dark. The real tragedy of life is when men are afraid of the light. Okay, so depreciation. So a company typically owns a variety of assets that has um, long lives, such as building equipment, motor vehicle. The period of service is referred to as a useful life of an asset. So because a building is expected to be of service for many years, it is recorded as an asset rather than an expense on the date it is acquired. So company records such asset at cost as required by historical cost principle. So to follow the expense recognition principle, companies allocate a portion of the cost as an expense during each period of the asset's useful life. So the depreciation is the process of allocating the cost of the asset to the expense over its useful life. Okay, so now the need for adjustments. So the acquisition of long-lived asset is essentially a long-term pre-payment, right, for the use of an asset. So an adjustment entry for depreciation is needed to recognize the cost that has been used and expense. So during the period and the reporting and to report the unused cost and asset at the end of the period. So one very important point to understand is that depreciation is an allocation concept, not a valuation concept, right? So the depreciation allocation, an asset cost to the period in which it is used. So depreciation does not attempt to report the actual change in the value of the asset. All right, so right here, so the our corporation is assuming the depreciation for the equipment is $480 a year. So that would give us $40 per month to adjust. Rather than decreasing credit, decrease the credit the asset account directly. We instead credit accumulated depreciation equipment. Okay, so we're going to have that account going. So the accumulated depreciation is called a contra asset account. So such an account is offset against the asset account on the balance sheet. So does the accumulated depreciation equipment account offset the asset equipment itself, the equipment account? So this account keeps track of the total amount of the depreciation expense taken over the life of the assets. So to keep the accounting equation in balance there, decrease the stockholders' equity by increasing an expense account, right? So we're going to have an expense account on that side, and then depreciation expense. Okay, so the balance in the accumulated depreciation equipment account will increase. So that'll be $40 a month, and then the balance in equipment remaining will still be $5,000. Okay, so the statement presentation, right? So the accumulated depreciation equipment is a contra asset account. It is offset against the equipment on the balance sheet. So the normal balance of the contra asset account is on the credit side. So the theoretical alternative to using a contra asset account would be to decrease credit. So that would be the asset account by the amount of the depreciation in each period. So by using the contra account, it is preferred preferable for a simple reason. It's disclosed both the original cost of the equipment and the total cost that has expired to date. So it does the balance sheet, right? So Sierra deducts accumulate depreciation equipment from its related asset account. So here's the way the presentation should look like on the balance sheet. Equipment less accumulate depreciation equipment. Okay. So what we are calling this is book value, right? Or carrying. So it's the difference between the cost of the depreciation asset and its related account depreciation. So the book value of the equipment at the balance sheet, right, is 4960. So the book value and the fair value of the asset are generally two different values, as noted right earlier. But the purpose of the depreciation is not to valuation. It's not valuation, right? We're not trying to evaluate the equipment, but it's a mean of cost allocation. So depreciation expense identifies the portion of the asset cost that expires during the period, right? In this case, it's October. Without this adjustment, the total asset, total stockholders' equity, and net income would be overstated. So that's why you gotta make sure we do these adjustments. Okay. All right. So just a real quick accounting for it. This is just a quick summary. So this is going to be the summary of the accounting for the prepaid expense, right? So here you go, examples, right, for insurance, supplies, advertising, rent, and depreciation. So depreciation is going to be considered prepaid expense, right? So the reason for adjustment is prepaid expense originally, right? Records in asset account have been used, right? So, and then accounting for adjustments, assets are overstated, expenses are understated. So that's why we gotta do that. And then adjusting entries. So we gotta expenses adjusting entries on the normal size would be debit, credit asset on credit on the asset side would be normal, and then our contra asset accounts. So just quick note, basically all contra accounts have increase, decrease, or normal balance opposite to the account to which they're related to. Okay, that was short. Thank you. Bye.